Okay, good afternoon to everyone. Today we are going to actually handle cost. Uh, Now, we have mentioned last time that there are certain constraints or limitation of any project. A project is limited by the time that is given to the project manager. The project is limited by the cost or the budget which is given to the project manager. Then the project is also limited by the quality which is given by the sponsor to the project manager, and also the project is limited by the scope. So therefore, cost is an important part of the function of the project manager. So today we are going to learn certain tools and techniques of how to do costing for any project. Now this is very important because most of the sponsor, or if you're a startup, then your possible pitch partners, they will be looking towards what numbers you're talking about, and therefore you need to have a structured way of creating a cost or a budget or a plan for managing cost. It's very simple, but definitely it's very, very important, because once you create something which is with a structure, you will be able to present it well. And when you present it well, your chance of approval is much more. So that's the background of the cost management program for any project that we handle. Now, what we need to understand in management of the cost, which is the competency or the skill that we are going to develop for ourselves, that as a project manager, do we determine the cost of the project? For example, someone has told you that please organize a uh, do you know how to estimate the picnic, and do you know how to determine the cost? And if you follow a structure, that means you're competent and you can apply that competency to any project in future, and you know how to estimate the cost. The second is, once you estimate the cost, then can you really monitor the budget? For example, you're going on a holiday and you're carrying, say, $10,000. Now you know $10,000 you're carrying because that's what you have budgeted for the holiday based on detailed calculation. Now, if you burst the budget or any item, either in travel or in food or some shopping, then obviously toward the end it will be very difficult for you, because you don't know how to manage the rest of the days in your holiday. And so monitoring the cost that you already planned and controlling the cost that you have planned is another competency. And when you you monitor and control against the baseline. Now, baseline is a terminology we use in the project management. Baseline is basically what was initially planned and approved. Whatever was initially planned and approved is called baseline. Now, against that baseline, you will always monitor whether you're going above that or going below that or going at par. So therefore, you will probably use this terminology very often, that how is your baseline looking, and against the baseline, how you're doing. The last one is the complete cost management process. So there is a process of the cost management. We will not cover that in great details. As I told you, these courses are full 1 month course. That means four hours a week for at least 4 weeks. So 16 contact hours. I'm trying to give you just the snapshot so that you're good enough to be a project manager, whatever project you're handling. So we will not get into great details of the cost management, but definitely we will know some tricks and some tips about how to manage the cost. So three competencies we are going to learn: establishment establishment of the budget, monitoring and controlling of the budget or the cost, and then managing the whole cost. Now, in the first session, I mentioned to you that there are 5 phases of any project. Those 5 phases are in red here. That means initiation stage, then the planning stage, then the implementation stage, then the monitoring stage, and lastly the closing stage. Now, each of the stage, there is a there is some function of a project manager managing the cost. So this will be a good one slide for you to keep in mind, and I'll take you through what are the main functions of the project manager in each of the 5 phases. For example, in the initiation stage, that means you have just decided to go for a holiday, not even got approved, not even engaged too many stakeholders. At that point of time, what is the cost management areas that you will be keeping in mind? The first thing you would keep in mind that where the funding is coming. And second is, if the funding is coming from a sponsor, what could be the requirement or an indicative budget that you would like to ask the sponsor to pay so that your project is from concept, the project is in flight. Now, second stage is planning. Now, for example, the sponsor has given you the money and you have got an approval. So now you start planning in great details how you're going to cost out the different stages, phases, and tasks of the project. And therefore, in the planning stage, what you will do is you will establish the budget, very detailed budget, and then you will get it approved and signed off by the sponsor. Now, what is the difference between this sign off and the previous sign off? The previous sign off was overall. Suppose someone tells you, I'm going to give you $10,000 for your holiday. That's an overall. But in the planning stage, you will divide the 10,000 into great details that, okay, so many dollars will be for your travel, so much should be for your food, so much for your hotel, so much for your shopping, so much for your sightseeing. So those details are done at the planning stage. And when you do those details, the devil is in the details, and you will find sometime that what has been given to you may not be adequate, or what has been given to you, you need to really demonstrate that you can handle the entire project and the quality given those details. So that's a sign off you do at the planning stage, means a detailed budgeting and detailed sign off. Now, at this point of time, you also do cash flow, because sometime you got the budget. For example, someone says that I'm going to give you $10,000 for the holiday, but the cash flow is almost towards the end of the holiday. So what happens in the beginning of the holiday? You have no money. Can you do the holiday? You can't. So the cash flow is very important. So to create the cash flows, that on week one, I must have $2,000, because with the $2,000 I can buy the tickets. On the week two, when you're about to leave, that's the time you're actually using another $2,000 for booking or giving the advance to the hotels. Okay, so therefore, if you don't get money on the first week and the second week and the third week as you require, your cash flow going to be negative. And this is one of the things which happens to the project manager. I've seen good project managers, they suddenly stop because they have got a good budget, but they haven't planned for the cash flow. Now, suppose you are working for a contractor. The contractors have got the tendency of giving you cash as late as possible. Now, if you don't agree the cash flow right at the beginning, you will start the project and you don't have cash, and then you're waiting for the cash to come. So therefore, at the planning stage, you will also create cash flow. So we will see some tools and techniques today that how to plan the cash flow. That's probably my last slide today. And then, of course, in the planning stage, you will be able to determine what is the return on the investment, or what is the recovery time for any strategic project. For example, a highway is being constructed, or a or a toll plaza has been put in a highway. Now you have to plan that how many years of toll is required to recover all the money which has been spent to create the highway project. Suppose you're going to Bombay to Pune. Okay. So you see that there are toll plazas, and these toll plazas, they have a life. Those life are probably 20 years or 30 years. Now you as a project manager will be determining those details also from the cost perspective, that $1 million has been spent for this road, and it'll take 20 years or 30 years to recover that. So that is also part of the cost management. Now that you've got the planning done, you're actually going to implement, suppose same road construction. So you will be monitoring the spending on a daily basis, on a weekly basis, on a monthly basis. What you will do is you will monitor how much you have given tender for, how much of procurement you have made, sand, cement, tar, equipment. So all these are the spend details are very accurately monitored during the implementation stage. Now, also in the implementation stage, you will have variations. For example, let's go back to the simple example of going for a holiday. Now, when you're going for a holiday, you planned that you will get a room in your budget. And what is the budget? Maybe $60 or $70 per night. But suddenly, when you go to book, you see that it's a high season. There's nothing available for $60 to $70. The minimum is about $100. So what do you do that? That's the time, if you want to continue with your project, you have the option of going back to the sponsor and say, look, my whole planning was based on $60 per night for my hotel, but now there's no way I could do for $60 because there's no hotel available. And if I have to go for this holiday, I need 100. So then what the sponsor will tell you, okay, create a variation. The variation means original was planned for 60, now it is 100, so the variation is 40. So create another variation report, go back to sponsor, the sponsor will sign off, and only then you can book the hotel for $100 because the variation has been approved. If the variation is not approved, what you do is you may dig into either the contingency, which we will discuss soon, economize somewhere else, save some money, and put in your hotel expenses. But again, that is monitoring and control. Okay, so you do the variations in the monitoring control stage. And last is when you close the project, you have taken $10,000 from the sponsor, you have to come and in the organization has asked you to go on a tour, and they have given you some rupees or some dollars for your tour expenses. That's given as an advance. So when you close the tour, when you come back, you need to give all the bills and total it out and say, okay, I have taken advance for 10,000, but I've spent 9,500, the balance 500 giving back to you. Or if you paid through credit cards, then you actually pay off all the bills to make sure that everything is complete. That's how you do the closing of a project. Okay, so therefore the blue ones are the highlighted portion that you need to remember, that you complete all the outstanding payments, every invoice which is given to you are settled. Then there is a financial audit is being done both by an internal auditor within the project team, which could be you or a designated finance guy, and also an external auditor, especially from the sponsor's perspective. And once the audit is being done, looks like all the expenses are approved within what has been told to you, and therefore these can be booked again the project. For example, when you're going on an official tour, you're allowed to have food and maybe some ice creams. But suppose you, instead of that, you have actually gone and ordered a bottle of beer or a glass of whiskey. So in the bill it will be written, if you're going to go give that in the finalization stage to your accounts officer, they will say, look, alcohols are not allowed, so therefore the bill that you have given I cannot pass, I will do an audit, and after audit, I'm reporting to you that this will be deducted. So those are the things which are being done at the audit stage. So now, just recapping quickly, this is the main overview of the 5 life cycle in which what you do at each stage. So initial stage you fund, the planning stage you budget, implementation stage you spend, in the monitoring stage you monitor and create any changes and therefore variations, and the closing stage you settle all the bills after audit so that the project can be completed. So you as a project manager is actually doing a function like an accountant or a financial CEO. So this is the overview of the today's topic. Now these are a couple of areas that you have to remember. What is the information that is required in the areas of cost? Remember, information and communication is one of the functions of the project manager. So for information, you need to record the information, you have to report the information. Now, as a project manager, you will have a cost record book, and you will have a cost management plan. You will have some financial reports. You will have some contract costs. That means if you're given contract to a subcontractor, those costs also you will capture. Then you will have those files, all the invoices, all the payment summaries, so that at the end you can create a profit and loss statement or just a cost management or the cost statement for your project. So if anyone asks you in the interview or when you're going to pitch for your project to a sponsor, remember to use some of these words so that the person knows that you are aware of the cost management requirement. That means you know you will be keeping some cost records. You will create some reports from time to time. You will not only create for your own team, but all outsource contracting costs also you'll keep in the files and records, and you will keep all the invoices for them to audit. And at the end, you will create a summary to give it to the sponsor. Now, in the cost management, you need to know what are the tools and techniques. Like last time, we used the PERT for time management. Remember, the PERT can be used also for costing. Same formula you can actually use for costing. That means for any item, if you don't know what you're estimating, you will use the PERT formula, which means that you will be saying what is the most likely cost, what is the optimistic cost, what is the pessimistic cost, and use that formula and say, after applying the formula, I'm going to use this cost to go to my sponsor and ask for the funding. Okay, so the PERT is applicable. That's one tool which we have covered last time. Now, other than that, there are certain estimating tools are available. One is called the analogous estimate. Analogous estimate is basically based on the past projects. So if you've gone on holiday to Shimla or Kashmir, next time if you're going to Kulu Manali, you have some idea what kind of cost happens. So based on past experience, a project manager can actually estimate the cost. But then there are parametric estimates where you have not done exact that project and the project is very complicated. There are probabilities, uh, and therefore you use parametrics estimate, means statistical relationship between what is to be delivered in what circumstances under what variables, and therefore you will be able to do a statistically valid estimate. Now what when those parametric estimates are being done, they are done when it's a very complex projects. And I always give this example, like suppose you're going to Mars or you're going to Venus, and when you're planning, how do you plan the costing for this project of sending a capsule to to say Venus? Then you will do statistical correlation of the past, that when you went to moon, you have some parameters, and based on that parameters, you created some uh, outputs in terms of what could be the cost. Now you extrapolate or regression techniques are used and then say, okay, with parametric estimation or statistics, I can get into very accurate costing. I'm sure some of you will be working in a very complex and very advanced technology field. You will be using a lot of parametric estimation at that point of time. But for the time being, keep it very simple. So don't worry about too much. Go for the analog, which is based on your past understanding. The second is the how do you determine the project budget or how do you estimate the project budget? There are two main routes that is being taken. One is bottoms up. That means you build the cost from task, and then total it up. So go from the bottom to the top. Another one is the top down. That means a total budget is given to you. Someone has told you, I can only give you 10,000 for this holiday, and you then from top to bottom you go down and say, okay, if 10,000 is the maximum, how much will be my budget for food, how much will be budget for my hotel, how many days I can go for this trip. So that's a bottom down approach. So remember, you will be using top down and bottoms up many times in the most simplistic project also. Now what I always suggest is try and do both and see where it meets. So for example, bottoms up means you go to the grassroots level of the cost. So I'm going day one, I'm going to land up in city one. In the city one, my hotel expenses so much, food expenses so much, travel expenses so much. Okay, that's the lowest level in the bottom. Then then you build this up to the higher level. That means okay, overall my transport cost is so much, overall my accommodation cost is so much, overall my entertainment cost is so much, and the total it up from bottom you go to the top and say okay, that is $10,000. If you do that parallelly, you also do the top down approach, you will see normally it doesn't match. Okay, because the assumptions are different in the two separate methods. So you will have a band in the middle where the top down will stop here or the bottoms up will stop here, so you know your budget will be somewhere in between. Okay, so use this uh, technique to establish accurately your project budget. The other concept that I'm going to introduce is called contingency. Now, contingency means that you cannot estimate. There are so many things which you don't know, whether there will be flight cancellation, whether there will be weather issues, whether there will be unrest, there could be falling sick, and you might miss your flight. So these are called contingencies that if those thing happens, then you need some money to fight over those situations. Now, because those are not known and therefore you can't plan whether top down, bottoms up, parametric, analogous, then what you do is you always keep some contingency which is separate. When you never touch that, you go with the contingency, come back with the contingency. If it is not required to be used, is the best situation. But in case it is required to be used, then you dig into the contingency, and that is called smart project management costing technique, because that's your reserve. Okay, that's your reserve. You always carry a purse, and a fifth, whatever, maybe 500 rupee note. You keep it in the reserve always. You don't touch that. Somewhere it's in your hidden pocket. Okay, so in project management also you do the same thing. So three concepts I have introduced here. One is the bottoms up, another is the top down approach, and I've introduced contingency as part of your budgeting exercise. Then after planning stage where the budget is being done, then we go for implementation and controlling stage. So you will see the last vertical, controlling cost. So basically, controlling cost in the project management, I'm introducing another concept called earned value methods. Okay, you can read later what is earned value methods. So project, suppose there's a 1-year project. Now your contractors or whoever you're dealing with, they will come in the month of February or March or April and give you a bill and say, boss, can you pay this bill because I need the cash flow. Now, if you do not know how to approve that bill, either you will be overpaying to the contractor or you will be underpaying to the contractor. Both are bad. If you pay to the contractor, it's like, the carpenter or the mason who comes to your house or the plumber who comes. It's a big job. They come 2 days, they get the money from you, and then they vanish. Because you overpaid, they can vanish because they know they got what more than what they have got. Who is the sufferer? You're the sufferer because you paid them more and now you're chasing your contractors. Okay. So you don't want to do that. If you underpay, then what happens? The carpenter or the plumber will say, sir, I have to buy this electrical equipment, I have to buy these woods and things like that for doing a construction or whatever interior decoration you're doing to your home. If you don't give me money, I have no money, and therefore your work stops. So uh, both way, if you underpay or overpay, both way, it is bad for the project and therefore bad for the project manager's management of the costing. That's why the tool I'm introducing here is called the earned value method. Earned value method means you will be establishing how much the person has earned that you need to disburse. Now, how will you do that? You will do with a simple estimation technique called against the baseline how much the progress has happened. Now, because the baseline is created task by task, and each task has got a cost associated with it, you will be able to establish when the task number 2 is complete, that means 20% of the project is over, or 2000 rupees has been consumed. If you could establish that, that means the contractor has earned 2000 rupees worth of or dollars worth of work, and therefore you don't mind paying the $2000. Okay, you're not paying 2500, you're not paying 1500, you're paying as he has earned. Very simplistically, to remember this, remember the percentage of the milestones or percentage of the total work has been progressed. That means that person has earned that percentage. So if the total value of the project is 10,000 and you think 50% has been progressed, that means he or she has earned $5,000, you pay $5,000. So that's the earned value. You read some through using the Google, there are more ways to establish the earned value, but I'm not complicating it today. I'm just keeping it simple that you establish what they have earned and only pay that. Okay. And then while controlling, I already talked about the variances. So variances are against the baseline. So against the baseline, if you know it has been positive, that means uh, in the project management term, the positive means you are within the budget. But if it is negative, means you have busted the budget, you have gone overboard, then either you go for a variance approval or you try to curtail somewhere else so that the project is back on track in terms of costing. So these are some of the tools and techniques at the estimation stage, at the budget stage, at the controlling stage. Okay. The highlights that you can see are the key in highlights in blue, the blue fonts are the key to remember. Now, what are the other tools that you use for monitoring? The simple tool is the Excel sheet. That means you will create everything and keep a record in the Excel sheet. A lot of people just use handwritten stuff in a diary uh, or uh, or shoebox technique, like all the bills which come, you don't do anything, just keep it on a shoebox, and then at the end you give it to a record keeper who takes each of the bill and enters in the software. So that's called a shoebox techniques, but mostly you will be doing this spreadsheet type. Now Also today, you probably can do something which is a software driven. You heard of Tally, you heard of Zero. These are the software where you can enter these details and the software creates uh, the output. So you need to know as a project manager because someone will ask you how will you monitor. So if that's been done, that question has been asked in an interview, you will say that I'll use a project management software or a financial management software, which could be like a Tally or a Zero. I will have the invoices entered regularly. I'll pay the invoices promptly so that every invoice is dealt with and there's no outstanding. And definitely there'll be an audit and checking, making sure that I have a system to pay as per the earned value and pay as per what is legitimately the rightful income for your contractors. Now, this slide is very important in terms of what are the components of a cost management plan. So you got an Excel sheet. Your bosses will expect you, or your financial CEO will expect you, or if you're the CEO of finance, you will be expected to create headings based on what is there in the slide. One heading is basically labor cost, equipment cost, and material cost, and the total cost. So when you're doing the costing, you will cost for how much of labor is required, how many manpower, how many man hours are required, and what will be the salary of those people. So that's a labor cost. Equipment cost could be, suppose you're constructing a road, you have hired the tractors and what is that, dumpers, um, machines for laying the tars. So those are the equipment. So under that heading called equipment, in your Excel sheet, you will be writing what is the equipment cost. And then material purchase, it's everyone knows. If you're making a cupboard in your home or renovating your kitchen, you're buying some tiles, those are material. You're buying some wood, those are material. You're buying some bulbs and lights, those are material. So you need to categorize and book the cost against these three headings. If you don't know what is labor, equipment, and material, you will not be considered as financially knowledgeable to handle a project. So therefore, remember that you should always use this vocabulary that I will book the total cost or break the total cost under labor cost, under equipment cost, on the material cost. Now then someone who is knowledgeable will ask you, do you know what's your direct cost and indirect cost? So you need to also then in bracket write labor cost or equipment cost or material cost, are they direct or indirect? Direct cost means direct costs. The easiest example will be, suppose you hired a car. Okay, now you're going from Bombay to Pune. Now the cost of petrol is direct cost to the travel distance. More distance you travel, more petrol you have to buy. So it's a directly linked to the project or the project scope. But what is the indirect cost? The indirect cost, whether you travel Bombay to Pune or you go from Bombay to Khandala and come back, it will be the cost of hiring of the one day of the car. You might just hire the car and go nowhere, still you have to pay whatever the cost had. So that's called indirect cost. Some of the examples of the indirect cost is in the office. Suppose you are working in the office. In the office, you will have electricity, you will have payments made for the rentals. So irrespective of whether you work or don't work, at the end there will be end of the month there will be bill coming from your landlord where you will be paying these indirect costs. Okay, so read a little bit more about direct costs and indirect costs because you will have to break or identify the labor, equipment, and material cost into which one is direct, which is indirect. And the last one is the contingency, which I've already discussed with you. Now, why direct and indirect costs are important for you to know? Because if the project gets delayed, remember your indirect costs are already on your shoulder. because the rent and electricity with every month you have to keep paying, whereas the direct cost can stop. Okay, because you're not doing any work, direct costs are stopped. So therefore, you will manage the indirect cost very, very carefully, because if you don't manage that, the project can go over budget. And the third concept that you need to know is the fixed and the variable cost. Very similar to the example that I gave you. The fixed cost is if you have hired the car for 1 day, the cost is fixed, irrespective of you keep it at home, go to Khandala or go to Pune or somewhere else. That is a fixed cost. The variable cost is the petrol cost, which is variable. Okay. So these are some of the terminologies that an accountant knows, and that's why they are professional accountant. But the good news is, as a project manager, you're also an accountant, because you manage you manage the cost part of your project. And that's what I always say, a project management integrates the entire MBA program, because in the MBA program you learn costing, marketing, risk management, different things. But if you do the project management, you know about the costings and you are practically skilled to the costing of the project and can manage the project, which in my opinion is the implementation of the management qualifications that you have acquired. Now, I told you that my last slide will be today the cash flow, because I explained to you, if the cash is not flowing on time, it is of no use. For example, today you have to go to college and you need 100 rupees for from your home to college, but your dad or mom or who is sponsoring you says that I can't give you 100 today, I'll give you tomorrow 200. It doesn't work for you, because 200 tomorrow is of no use, because today you need 100 to give it to the Uber or give it to the bus or the train. Okay, so therefore it is not the total which is important. It is important when, at what periodicity the total comes to you. Okay, this is a major mistake most of the project managers make. They are very good in costing, but they make a mistake of bad cash flow, and therefore the project gets stuck. So that's why I'm going to explain a little bit. The cash flow means the net cash balance. That means income has come from your sponsor and you've spent some money to your contractors. The net is your bank balance. So you have got $100 in, $80 out, 220 is your bank balance. So that is your net cash balance. You need to keep in mind that the net balance for a project manager or a project should always be positive. Not a single day, not a single week, not a single month. Your net cash balance in your bank for the project can be negative. Okay, so therefore, you need to plan this in advance and then ask for it and agree to that cash flow. How do you do that? You do that with what is called an S curve. Now, what is an S curve? It's a very simple formula. The S curve is basically you cumulate or keep adding the costs. You cumulate or keep adding the cost. So first day you started the project and you spend say $500. The second day you spend say $1,000. So how much you cumulatively spend at the end of second day? 500 plus 1,000, 1,500. Okay. Now third day you have again spent another $500. So at the end of the third day, your total cumulative expense is 500 plus 1,000 plus 500, total 2,000. So you got three data. Day one, 500, day two, 1,500, day three, 2,000. So these are the cumulative expense for the project. That means till now, till date, you have spent, till date on the third day, you have spent $2,000. Now, if you plot those data, that means first day 500, second day cumulative is 1,500, third day cumulative is 2,000, you will get an S curve which looks like this. Okay, so this is a tool I'm introducing for you to learn and use. It's a very simple tool. Use Excel spreadsheet, write the cost during planning, write the planned cost, and during execution, you write actual cost spent. Just third column, you say cumulative. Do the S curve. Now, how do you monitor? How do you monitor? You monitor by planned one, suppose that is in blue, which is called the baseline or the base S curve, and the actual could be in, say, another color, say black. Now, if those two S curves match, and not only they match, if the planned one is more than the actual one, then you're doing well. That means you planned for more expenses, but actually spending less. That means always you will have a positive cash flow. But if you see if your actual is more, then you are doomed because your project will stop because there's no money. Okay, so read a little bit more about S curve, and in the interview or in real life working in your project, you will do S curve during planning and you will do S curve during monitoring. And then you will see if the S curve is looking healthy, that means you're doing very well in the cost management of your project. So I've introduced today all the costing. Now I already talked about contingency, so I'm not going to take this chart in great details. So contingency means basically something which cannot be planned. So you keep some money extra, and those are used for any variations in labor cost, material cost, or contract cost, or scope creeps, means additional scopes coming in. Read the slide and know that contingency is used for this purpose. Remember, normally always in a very well defined, well understood, and almost known project, still you will keep 5% contingency. Is a thumb rule. If you're not very sure, you keep 10% contingency. All other projects, when you're absolutely playing blind, then your contingency must be more than 10%. Sometimes it is 20 or 30% is contingency. So I've given you 3 thumb rules. When you're doing a budgeting, if it is a simple project, you know all the costs, 5%. If you know all the costs, but you can think something can go wrong, 10%. And if it is unknown, it will be 20 or 30 for 20, 25 or 30%. Now with this, you have now understood the cost management tools and techniques and why it is being done, how it is being done. So you can now apply that in an activity to practice that in your project, you can actually do the costing, do the phase-wise costing, create the S curve and match the S curve, which is planned S curve versus actual S curve. If the planned ones are more, then you will be doing very well as a project manager. With this, I will end today and have the question answer now.
Okay,